Hi, this is Harry Feiner with William Raveis Real Estate. I'm here with Paul Adamo, who was with William Raveis Mortgage, and he's our executive banker. How you doing today, Paul?
I'm good, Harry. Thanks for having me.
Oh, good to be here again. And what we're going to do is a little bit of update on what's going on in this crazy market, not only with housing, but also with loans.
Yeah, so what we've seen over the last few months, interest rates popping up. The old dogs like us are still fairly low.
Who's old?
But we're seeing them now get back to almost where the rates were in 2018, a year before COVID. They're hovering right around the 5% mark, maybe an eighth below, an eighth above, with the APR being about 0.125 more than that. But then again, what could fluctuate the rate? Credit score, property type, down payment. So again, still great rates, just not what we saw once COVID hit, and between 2019 and just a few months ago.
Yeah, so we're back to the norm we had a number of years ago. And
yeah, we're back to really still attractive interest rates.
Yeah.
If you only go back a couple of years.
If we go back a lot of years, in '86, I had a 16% mortgage.
Yeah, and I had, because I'm younger than you, I think my house was 13 or 14% my first purchase.
Yeah.
So we're still good.
It's really changed a lot, hasn't it?
Yeah, it has.
So is there anything new with people who were required to put down PMI, and is there some way to incorporate the PMI into the loan? Or
Yes, so there is lender paid mortgage insurance. So instead of, and I just saw arbitrary numbers, somebody paying $50 a month, maybe they pay nothing a month, but then the interest rate will be a little bit higher. So the thing to keep in mind, PMI, or the private mortgage insurance, has decreased over the years.
Oh, that's good.
One of the few insurances that has over the years. But again, that's credit score driven, property, a lot of factors go into that. So we've had people, instead of going 20% down, maybe they put only 15% down and 10% down, because that money they're saving to go towards the house, whether they have to do repairs or anything, it bumps up the PMI, or it bumps up the monthly payment. They can hang on to $20,000, $30,000, $40,000. So we mix and match it. It's almost like a puzzle. What works best for the right person?
So if we go way back, maybe 10 years ago, a lot of people would pay a point to get a better interest rate.
Yeah.
Do you see that? Has that come back at all?
Actually, it probably will start coming back. Now, if you go back 10 years ago, a point dropped the interest rate a lot more than it does today.
I see.
A point might have done 0.5% or maybe more. Now the point does maybe an eighth or 1/4% off the rate. But I think we're going to start trending that way, where, again, we present it to the buyer. Do you want to increase your closing costs by $2,000 if the 1 point is that much, and lower your monthly payment by $50? So again, we mix and match to see where the break-even point is. Are they getting that money back in 12 months for the point? Is it 36 months? But yeah, that is an option. I think we'll see that.
And a point is basically 1% of the mortgage rate.
Yep.
So if it's a $3,000 mortgage, you're going to pay.
Well, a $300,000 purchase.
Yep.
Or loan would be a $3,000 point. And then keep in mind, it doesn't have to be a 1%. There's 0.5%. There's 0.75%.
Oh, I didn't know that.
There's 1 and an eighth. Yep. So it's never. I mean, it could be, but it doesn't always have to be an even number. So maybe somebody that only wants to pay 0.5 point versus a point. And again, it's just part of the equation we try to solve.
Well, thanks, Paul, for the update.
Yeah, thank you.
Again, Paul Adamo, Harry Feiner, and we're with William Raveis Mortgage and William Raveis Real Estate. And thanks for watching the Feiner Real Estate Video Network.